So I guess maybe one thing that you guys can talk about, because I think this is a topic of conversation that I've had more frequently with clients, and that is we're obviously seeing a higher proportionate share of variable rate selection over fixed rates than what we've seen in the past, right? The concern is that we as human beings don't like that fluctuation because we want the certainty with our payment. And so are you finding that most borrowers are opting for a fixed payment variable where the payment stays the same, but your share of interest to principal changes? Like, is that kind of the product that you guys see for end users right now?
It's not offered by everyone. So like that adjustable type rate mortgage where you do get your monthly payment stays the same, but the fluctuation of principal to interest, it isn't necessarily offered by everyone. I still see, and I think it just kind of helped. Well, it in terms of who our clientele is mainly focused on, with it being kind of the investors. I still find the shift really is on, or the focus is still on like the variable rate. I haven't really had a whole lot of people take the fixed rates. Where I am seeing a lot more take like a 2-year or a 3-year fixed is on the B side, just where the rates are right now. And we're saying like a residence is around 5.5, a rental property is at 6, and then you're probably 15 to 20 basis points above that on like a 2-year. But you're really just kind of hedging the market in terms of where you're going to be at the end of the year, and do you think the market's going to go up or stay the same? Most people are taking around a 2-year on the B side, but in terms of that like adjustable type rate, I haven't had very many people ask for it, to be completely honest. So
I think strategy is more important to investors than rate at the moment. You take a look at where rates are at, and you're about a 2% difference, almost 2% difference from variable to fixed at the moment, depending on which rate you're getting, which essentially means that if you're expecting the Bank of Canada to raise their overnight lending rate by 2% over the next, say, 12 to 24 months, you're in a better position to actually take the variable term now and slowly take on the increase in payment as the overnight lending rate increases, because you're not going to go right to that 4.5% fixed rate and lock it in and just absorb that cost up front. And it still keeps that variability in regards to being able to restructure your debt down the road. A lot of investors are choosing their rate and terms based off of their investment strategy. And the smart ones who planned it out, who saw it coming, this isn't news to them. Like they obviously had cash flow to buffer out this situation. They understand what their cash flow situation looks like, and they're staying decently consistent with it.